All righty. So today is May 8th, 2020, and I want to thank you for joining our webinar today. So as a lot of you know that I've been doing this for the last, actually about 6 or 7 weeks, giving everybody a quick update on the real estate market and how COVID has been affecting the real estate market. I'm going to dive into this today. We also have a guest speaker. I'm going to go through some of my market stats, and then we brought on Dan Vieland today with Vertical Charter. Was it Partners?
Investments.
Yeah, Vertical Charter Investments. That's close.
Yeah.
A good friend of mine who is a financial planner and can kind of give us some ideas of what's actually been happening on the investment side and with the markets and how that's all been playing out. So let's dive into this. So I started doing this the last week of March, and just kind of a really fast, recap. Obviously, in the middle of March, we closed all the schools in Ohio. The pandemic really started ramping up. We did start to see a little bit of shift in real estate, just a tiny bit. The last week of March, that's when we did the lockdown or the shelter-in-place orders. That's when we really did start to see some shift in the real estate market. Interest rates were pretty volatile. They were going up, they were going down. The week ending April 3rd, more and more states were issuing stay-in-place orders. Unemployment obviously started to skyrocket. That's really the week we could go back and see that real estate started to be affected. The interesting thing the thing that was affected the most was new listings. So the number of new listings hitting the market was down about 30%. And then we also noticed that homes in higher price ranges were getting a lot less showings. The week ending April 10th, again, more and more states issuing stay-in-place orders. The stock market was obviously going up and down, which Dan's going to talk more about here in a little bit. The real estate market did start to stabilize, though. New listings were still down, and lenders started to tighten guidelines, but we were still putting homes under contract. The week April 17th, more flattening of the curve of the pandemic. That's when we finally started to see a little, light at the end of the tunnel. Stock market's still up and down. Real estate market starting again to kind of rebound a little bit. The week 24th, more and more flattening the curve. What we really started to see, unemployment, of course, rates are going through the roof. Congress did start passing more and more stimulus money, which has been helping a lot of small businesses. We still have seen really a shortage of listings, which we're going to dive into in a second here. We're going to talk more from Dan here in a little bit. Let's get to a different graph that I have up. And I wanted to show what actually is happening today. So I did talk about a couple of webinars ago, the big differences between what's happened in 2008 and what's happened in 2020, and the differences when it comes to the real estate market and how we're going to be affected. We can talk about that just for a second. So back in 2008, there was a ton of homes for sale versus today. We don't have a lot of homes for sale. Back in 2008, the interest rates were 7 or 6%. Today interest rates are historically low. Back in 2008, there was a huge loosening of guidelines to qualify for a mortgage. So way too many people were in a mortgage that couldn't afford it. Since then, they've really tightened up the way lenders work, and there was a lot of phony appraisals going on. There's all kinds of funny business going on. We've really not seen that. So lenders have not been making those low risk loans. There was a huge challenge of the mortgage-backed securities collapsing. And that's really what caused our financial crisis back in 2008. This time, it's really COVID-19 causing a pandemic. It's more of a health crisis than a financial crisis. And another big difference is this time around, there's so many more homeowners have equity in their houses. You know, back in '08, people were getting mortgages for 125% of the purchase price of the mortgage amount, taking that money and running to the furniture store or to Costco and buying the big screen TVs. So few people had any equity. When the market did shift a little bit, that's when everybody was upside down, and when they needed to sell their house, they had all the foreclosures. That's all old news. This is what's going on today. So as of yesterday, actually 2 days ago, the blue line's new listings. The light green line is number of homes for sale that are available to sell. The dark green is the number of homes that have sold. And the red is the month they went under contract. We call that pending. And this is a 12-month graph, and you can kind of see what's been going on here. There's more homes for sale in the summer. That's why you see the light green bar really high in the summer months. Last August, August of 18, or August of 19, and June of 19, and September of 19, a lot of homes for sale. And then historically, they come off the market. Less people are trying to sell over the winter. The thing I really want to pay attention to, though, is what's been going on and what has happened this year for the first 4 months versus last year for the first 4 months. The crazy thing to look at is when you look over here, number of homes for sale is down 40% for the first 4 months, basically 4 months and 6 days of 19 versus 20. So a lot less homes for sale, which we would expect with the whole COVID going on. The amount of new listings hitting the market is down 20%. The interesting thing, though, is the number of homes that have actually transferred is flat. And the number of homes that are gone under contract is only down 2.6%. So a lot of folks were worried that the whole market was going to come to a screeching halt. That didn't happen. A lot of people have stopped putting their homes on the market, but the buyers are still out there snapping these homes up. If you look down at the bottom chart over here on the right, this talks about a rolling 12 months. So from May of 19 to April of 20 versus May of 18 through April of 19. What's going on? And you can see, yes, number of available homes for sale is down. Number of new listings is down only 3%. Number of solds is pretty flat, and the number of pendings is pretty flat from last year. So for a rolling 12. So when we look at these kind of numbers, we can say that, it's still a really strong seller's market, which actually this is the graph that shows that for the realtor world, if we have less than 3 months, that's why that bar is up there, worth of inventory, it's a seller's market. You can see in the winter, that's why this graph goes up. It becomes more of a neutral market. If we get between 3 and 6 months worth of inventory, it's a neutral market. Anything over 6 months worth of inventory, it's a strong buyer's market, which this spring has become even a stronger seller's market than actually any year I've been in. So in the last 25 years. So strong seller's market. And this graph that I zipped by before does show that this is the rolling 12 months. Sold prices are up about 6%. And actually, believe it or not, for the first 4 months of 20 versus the first 4 months of 19, average sale price is up 11%. So, I mean, that's actually kind of contradicts what some of us thought was actually going to be happening. As an asterisk, these stats are for the western suburbs. So everything from probably pretty much downtown to eastern Lorain County, all the way down 71 and 77. They do pretty much hold true for the east side as well, too. I don't have a chart for this, but what I am seeing is the number of new listings is getting back to normal. So the week over week, how many new listings we're adding to the market? We hit our low point the 4th week of March to the middle of April. And for the last couple of weeks, we're starting to see that line trend back up. So that's great news. So more and more folks are getting their houses on the market. I can tell you that, we've had a couple houses go live here in the last couple of weeks, and everything's selling. I mean, and it's selling quick, very, very quick. So let's turn it over to Dan. So that's your quick market update. If you have any questions specific to your area, your house, feel free to reach out to myself or somebody on our team. We can get you those stats for any particular house or neighborhood. And that's really what you should be getting from your realtor too. So if your realtor can't give you stats like that, live, up to date with exactly what's going on, you've got the wrong realtor. And that's why I asked Dan to come on too. So Dan, I guess maybe tell us a little bit about yourself real quick. And then I know we had some questions that some of my other customers have asked me to ask you, but tell us a little bit about yourself.
Yeah, thank you. That was interesting stats too, by the way. The buyers are out there, the sellers aren't. And you got to think, when more sellers get on the market, the appetite to buy will have to increase as well. So the percentages are really interesting.
Yeah.
Good news, actually. And,
Yeah.
well, I'm a financial advisor. I partner with registered investment advisor, Stratos Wealth Partners, out of Beechwood, Ohio. And I have my own planning firm, advisor firm, which is Vertical Charter Investments. Started in the industry 22 years ago, and so much has changed, just like everything else. But it's been a great ride. And one thing I could tell you is that I've seen the consumer basically in our world is just smarter, and just like testament to there's more equity in homes. I think that's partly because of smarter consumers now, and investors are smarter. I haven't had a lot of people just selling out when the market dropped. And I'll bring up some charts here.
You lived through the last crash too, right? So I mean, what was that? I mean, that had to be scary.
Yeah, and I'll tell you, the behavior of the retail investor is better this time around, and it's certainly better than the .com crash. I mean, we had that was a tough one because we had 3 long years of just markets dropping, and it made people feel like we're never going to get back. I mean, the last couple crashes though have been, we refer to them as like a V bottom. Now this might be a retraction in this market, and we might see another downward spike, but I think we've seen these come back more robustly. And so I still look back at that 2001 to 2003 as a really rough patch, because it was just a long, drawn out process. A lot of things happened. .com, 9/11, WorldCom, Enron, that all just kind of kept flowing in.
Right.
And so we have to hope that, nothing else happens on top of all of this. There's a lot of hope out there, and the market is just, it's rising. Sometimes in a really bad sell-off, there's a reversion to the mean kind of, or, the market just pops back up. And maybe that happened, maybe it didn't. One thing that I saw in the headline in the Journal today that I thought was interesting was that the unemployment rate rose to a record 14.7%. And that's unbelievable. But,
Great.
You have to remember too, that there's a lot of people out there that were never allowed to be part of the unemployment range, such as like waiters and waitresses,
right.
Gig workers. Now they're allowed to file unemployment. So that's added to it. But
that's right. I never thought about that, because I've been reading those stats now that you mentioned that. And that's a great point. Yeah.
Well, and the high, so this went over the highest data that we've ever had. And let's see, back in 1948, it was 10.8% unemployment. And then the Great Depression, we didn't keep these numbers. So the economists estimate that we're at 25%. So we're not there yet. But here's another
thank God
piece of optimism for you. Of the unemployment numbers, and I read this from, this is from Erica Grosjean in the same article, but she's the former commissioner of the Bureau of Labor Stats. And she says that 83% of the increase in unemployment in March came from workers that are temporarily furloughed, not permanently laid off. And so these people are expecting to go right back to work as soon as the economy opens. So with that being said, I mean, you can kind of see why the anticipation of the market is there to be at such a large increase.
Right.
And so, just to kind of here, I'll share this chart with you. This is just the Dow Jones Industrial Average. And if we just look year to date, I mean, we all know about the sell-off. I mean, it came down. what's interesting here is the volume down here. You can see in these sell-offs, that's where, you know, it starts to sell, people start selling, or maybe computers start selling. That's what we're kind of seeing.
Right.
And the volume just, in these bar chart down here, it just shows how much is just capitulated into that. And then we see some upward movement, but then, you know, it kind of tapers off. I mean, if we look long-term, the volume is not light by any measure, but at the same time, it's there. And by the way, you know, so where were we? How long ago was it? A year ago, we were at these numbers at the Dow. And then we have to go back. We were still there back in December of 17.
Wow.
So, you know, we've got a long ways to go. We still have a big chunk to go to get back up to the all-time highs. But yeah, it's just an interesting chart. You know, it's good to look at where we've been, where we're going, and where we're heading. So I think what this has offered, and let me get back here. Stop share. Yeah. So what this has offered, it's a bit of a reset to say, okay, we took that big hit, and, you know, just like I told my clients, we're not going to sell out. We don't want to be wrong in cash, sitting in cash that we used to be in equities. And now that we're come back up a little bit, you can kind of reset yourself and say, okay, well, now can I handle that again? What if it's a longer term sell-off? What if these unemployment numbers don't improve? What if the virus comes back and we're stuck at home again and everything is worse? Where should I be? So it gives you an opportunity to kind of reset yourself and think about making sure that your portfolio is aligned with your long-term goals. And I'm not saying, you know, hey, we've come back up, so sell out, you know, but it does give you time to kind of reassess things and think about, you know, what you own. Make sure you own good quality stuff, that kind of thing.
So is this a time, you know, I've talked to friends and, you know, they're like, hey, I actually talked to one person and he's got his son as far as they're doing this for like math class, you know, and they're like, hey, you know what? I showed my son, we opened a little E-Trade account. We bought a little stock, you know, we're kind of playing with it, that's fun, you know, if you're doing that with a couple $100 or $500, whatever. What do you say about folks that are, you know, maybe now they're sitting at home and I'm swamped. I know there are folks that are sitting at home with not much to do and that have time to look at some of this. Is it time to start maybe picking your own stocks? Or I guess what are you, obviously you're a planner, so you have an opinion on that, but I guess what's your thought on that?
I think it's good for people to have their own investments. It wasn't that long ago that we weren't really working in this 401k world. We were working in, you know, when people made investments, it was with discretionary money and they relied on their pension. And so, you know, you knew when you were investing someone's money a while ago, they had some appetite for risk. And so, but it's good to have some vested interest in. I mean, everyone has a company they like. Everybody has some kind of product that they like to use. And it's kind of a interesting thought, like, why not invest in that company? And if you see that the company's down 50% today, well, why not? Why not go into it? But you do have to be smart about it if you're new to this. I mean, the discount brokers, I mean, the big three are Fidelity, TD Ameritrade, Schwab, and also, well, E-Trade. Yeah, so we could say the big four. But, you know, they've kind of lent themselves to kind of a playground for, you know, being able to trade around and have some fun.
Right.
A couple things I would look for and caution. First, if you're investing in companies that you know, make sure that when you look at it, you're going to see on those websites and those trading sites that you'll see a spread, a bid and ask spread, and that kind of tells you how often this stock is traded. You don't want to get caught with all the other risks ahead of you right now and being new to trading, if this is new for you, in something that's not very liquid. And you can see that, you know, if you're looking at a stock and when you're looking at the price changes and the bid and ask is about a penny apart, I mean, you can sell and buy this thing all day long.
Yeah.
If it's 20 cents apart, you might have some problems here and there getting in and out of it with the price that you think you're going to get. The other thing to do is, you know, if protect yourself from your own emotions. There's a couple different ways to do that. You know, you see a stock go up and you think, boy, I just made 20%. I better take my money and run. And right before you hit that trade button, you think, no, this thing's going up and I can't live with myself if I don't make the next 20%. So, you know, there's a couple fun little trade orders that you could put in there. And they're very purposeful. You know, you could use a stop loss order.
Right.
And you could do that with percentages or dollars. I'll stick with dollars. It's the one I like to use. But basically you say, if you have a $50 stock, you want to limit the loss to maybe $2. So that's like a 4% loss. You know, you want to give it a little bit of wiggle room. So that way, if it goes up, you don't miss out. You didn't just sell out. But if it goes down and your biggest fears are realize that, hey, this thing hit its top, at least you're automatically out. Your emotions didn't get in the way.
That's a good idea. Yeah.
And then at the end of the day, you know, hey, if this thing went to 60, well, you got to reassess your stop loss. I mean, you don't want to go down to 48 now. I mean, now you're up to 60. So the other way to do it is do a trailing stop. And so you don't really have to think about it too much. You can just say, I'm going to put that $2 loss parameter on there and I'm going to trail it. So if the stock goes to 55, your new stop loss is 53.
Gotcha.
Okay. So, and if you think about that, you're actually squeezing yourself out of the stock with percentages. So if you're at 50, and you're going to sell at 48, that's a 4% loss.
Right.
If you're at, to make it easy, if you're at 100, a $2 loss is 2%. So
right.
You're kind of squeezing yourself into a smaller loss.
That's interesting. I didn't ever know about that. So that's useful.
It helps the most experienced. Yeah, it helps the most experienced, and it helps the new person not get in their own way. So, yeah.
And emotion is probably a big piece of it. I would assume, have you had a lot of your clients going, you're going, oh my gosh, sky's falling. Do we get out? I mean, you know, what's been going on? They're all worried about the 401ks. I guess, what's that look like?
Well, I think most of my clients call or I call them, you know, first. I try to get in front of them quicker, you know, but some of them beat me to the punch, and they would usually say something like, we're okay, right? I mean, you know, where are we? And you know, should I even ask, that kind of stuff? And you know, for most part, most of my clients are near retirement or in retirement. And so they're in fairly conservative portfolios. We didn't take much of a hit. You know, so it was relative. You know, I have younger clients that are in aggressive portfolios, and I think, you know, we've been around long enough. We understand the financial plan that's in place. We understand their goals, and we understand, you know, that these things are going to happen. And so no one's really panicked, but I've seen more people that were not my clients asking these questions. You know, what should I do? Should I just, you know, or gosh, I was thinking about going to cash, you know, back in January. And it's like, well, why were you going to go to cash?
Right.
You know, that's not a good long-term approach either. But so, yeah, I've had those questions, and I don't think that, but again, we go back to the consumer being smarter now. And you know, financial crisis, there was more of this. 01 to 03, more people were thinking, boy, I'm in big trouble here. But nowadays, I think people are just better at this. There's more information. We've been through more of it.
Yeah.
Think about 20 years, we've gone through 3 major catastrophes. That's unprecedented.
Yeah. And the crazy part is, in this one, and I think, you know, for everybody that's been paying attention, is it's totally really, it's creating the financial crisis, or, you know, downward trend in the market, and it's creating issues in real estate, and it's creating all these other issues. It's the pandemic. It's not that there was a problem in the stock market. I mean, we could argue that all day long, that maybe it was a little overinflated, but it's now an outside influence. You know, those other things were actually mechanically inside of it, were causing the issues. And everything does cycle, like you said. I mean, it doesn't matter what's really causing it. If you go back, same to real estate values, and which we really don't see crashing. You know, I think now that we were a little more worried a couple months ago when this first started. I think now, at least locally, you know, we're so lucky here in Northeastern Ohio. Most of our economy is not based on travel and industry, the travel industry, or hospitality. You know, which we don't have a big convention center or anything. We do, but nothing like in Orlando or Vegas, or, you know, those places are going to get really slammed over. You know, Sure, I bet you Sandusky's going to take a hit. If they can't open Cedar Point up soon, that's going to be a challenge. But for the most part, Northeastern Ohio should be able to rebound pretty quick from this, because it's not something that was amiss inside of the market, whether it's the stock market, the real estate market, or whatever. So, and we're going to have an interesting time to see how this all plays out. So,
Yeah.
go ahead.
There's not an underlying fundamental problem
Right.
that caused this.
Right.
Yeah. And
like last time, last 2 times, really, right? The .com and or all the mortgage-backed securities collapsing.
Yeah, and you mentioned Cedar Point. Cedar Fair is, that stock has rallied back 100% from its lows.
Has it really? Wow.
It's not back up to its highs, but it's 100% to its lows. And I think that, again, that's the optimism of what is going to happen in the near future. But they have property all over the country too. So
yeah, they just bought Sawmill. Thank goodness. They got to clean that place up. But anyway, what else do we ask? Other questions about 401ks? We got that. What's, I guess, long-term outlook? I guess we kind of touched on that. We talked about, playing the stock market yourself. Let me see if anybody else has any questions in the question and answer box. Right now, no questions, but if you do, feel free to shoot us over a question. I guess how, you kind of started going on this. How do you get like advice from a planner like yourself?
Yeah,
What's the best way? I mean, so obviously there's, I can go do this on my own on, E-Trade, stocks, or, Scottrade or wherever. And they've got a bunch of tools. I guess what are our options, I guess, when it comes to that?
Yeah, you have a few options. If you've worked with somebody for a long time, you kind of understand your level of trust and level of, that you understand that they're doing everything that they can for you, and everything they've done has worked out very well, and you're very happy, and that's great. And sometimes you just think, if I were to go back to this person and get a financial plan done, is it possible to be unbiased? And I think most relationships, long-term relationships, they have your best interest in mind, which is your advisor. But if you want to get that second opinion, and it's something that happens in this industry all the time, when someone says, hey, can I get you a second set of eyes on that? Can I give you a second opinion? What you should be looking for in a second opinion is really somebody that would take a fee to give you an opinion without the anticipation that you're going to bring assets to them. And I think that's really the only way.
Right. So they get paid up front, as opposed to, okay, I'll give you a little free advice. Hopefully I'll then make, money off you for the next 5-10 years.
Right. Yeah. And nothing's free, right? So, I mean, there's always a hidden agenda. If someone's going to put, 12 hours into putting a financial plan together for you, and for free, I mean, that doesn't even make sense.
Right.
So they would anticipate that
you get what you pay for, right?
Yeah, exactly. And so there are financial plans. Most registered investment advisors, in fact, all, as far as I know, could possibly, put together a financial plan for somebody, which would include goal orientation. So most people want to understand their retirement probabilities, right? And can I retire? Am I on the right track? And those kind of, that's the big one. I mean, there's education goals. There's, I want the second house in Florida, all the different things that can come up. Any goal.
How do I sign up for that one?
The second house in Florida?
I want the second house in Florida.
That's your department, right?
Yeah, exactly. I need to be able to afford the second house first. Then I can go find it.
Yeah. Well, you sign up for a financial plan to understand if you can do that. That's right. But if you approach somebody and say, hey, I am not going to bring any assets to you. Do you charge a fee to put a plan together for me? Can you do that? And if you find that person, best way to find that is through word of mouth or something like that. You talk to some people that have another advisor, and you approach that person, and hopefully they'll agree to do that. And if they've done it in the past, it shouldn't be hard for them to accommodate you.
Is that something you should
even do? Fee will. Go ahead. Oh, go ahead. The fee will set it aside, so that they have an obligation to act in your best interest. There should be a contract in place that this plan is going to be delivered. And it should cover those topics of goals and things of that nature, including your current portfolio with your 401k involved for asset allocation purposes, and the money that you have with your current advisor. Again, this isn't to fire your advisor. This is just to say, I want to make sure, I just want to have more conviction in everything I'm doing across the board.
Right. So is this something, I know a lot of people look at investing as, okay, I go to work, I have a 401k, maybe I, got a little bit of matching, so I put some more money towards that. Is that something you could even do if you have a 401k? I guess I think sometimes people think financial planner, I don't have enough money or I don't manage enough money to even start talking about that. I guess maybe explain that a little bit.
Yeah, the financial plan is agnostic to how much money you have.
Okay.
Other than the fact that if you can't afford to pay for the plan, then, that would be the only outlier there. But, depending on if your money is all in a 401k and you've been at the same job for 25 years and simply you just can't take it out and invest it with somebody, that is not something that you should have to worry about if you're working on a financial plan, because it's also going to cover insurance. It's going to cover, when I say insurance, I'm talking about life insurance, long-term care needs. Your estate plan would be involved, possibly your property and casualty insurance. So as you see, a financial planner then is kind of the center point to all those pieces. And even in your home value, you should work with a good real estate agent that can kind of give you the kind of details that you're giving. Yeah, right. Exactly. And yeah, it's terrific numbers that you give out. And obviously you have to have a property and casualty insurance agent. The planner can't do all these things. They could kind of give you the idea of where you should be. And if it's a 401k, those are governed under different guidelines. So the financial planner can't tell you which exact funds to buy in the 401k, but they can give you an allocation idea of saying, you should have X amount of bonds, X amount of stocks. Now there are ways that advisors can facilitate more direct advice inside of 401ks or 403b plans. Okay. But it's not necessarily always, don't expect that 100% of the time from a financial planner exactly which investments to buy. But the allocation is the most important part anyway. Okay. Most of the time, your total return is going to be based on your allocation. And it should be in line with not only your goals, but also your aptitude to take risk. As I mentioned, we used to work with people that invested discretionary money and relied on a pension. Now everybody has to be an investor in a 401k plan. So everybody, whether you're not wired to be an investor or not, you're investing. Right. Unless you don't want to retire. Yeah. And putting your money in cash is an investment. So you have to, weigh that. It's okay to be in cash if that's all the risk that you can take, but that you just have to understand what that means as far as how are you going to achieve your goals. Right.
Interesting. So I guess just to wrap it up, do you have your crystal ball? Pull out your crystal ball, dust it off. What do you see, maybe short term happening like with the market? And then maybe long term, I don't know, or whatever, or however you can address that question.
I think, it's just the old phrase, prepare for the worst and hope for the best. And short term, right. Long term, we're going to be okay. Right. Resources aren't growing, but the population is. And so, supply demand is going to necessitate that, things are going to get better. And, right. But I mean, you have to be prepared that, we're probably going to have another correction or, we're going to tread backwards again. Every single year, almost, we take approximately a 10% drop. It was only in 2018 in December, we took a 20% drop. 2 years before that, we took an 11%, and the year before that, we took a 12% drop. So these things always happen.
Right. And that's throughout the year. But then
throughout the year, yeah.
Right, because it's the normal cycles through the year, yeah.
Yeah, but it doesn't mean, when I say be prepared, I don't mean jump out of the stock market and go into cash. Mm. Remember, this has given everybody an opportunity to revisit their long-term plans, and their current portfolio and make sure that it's lined up with what they're trying to achieve and with their risk tolerance.
Right. Awesome. Well, thanks for joining us today, Dan. Appreciate it. Thanks for the insight on the stock market. And if anybody needs to reach out to Dan directly, you can send me just send me an email or put something in the chat, and I can make sure you get all Dan's information. Boy, we dropped the ball on that, didn't I? We should have a screen pop up with all your information. Next time we'll do that. So
Next time.
Exactly.
Yeah. Well, hey, I appreciate it. Thank you very much, and great insight by you for the real estate market as well.
I appreciate it. We'll stay in touch. Already. Thanks, Dan. Thanks for everything.
All right. Take care.